Thank you, Miami, for the last 3 years in this amazing city. The whole world shut down, but Miami welcomed us with open arms. We want to show Bitcoin to the whole world. We are taking the conference on the road to set the stage for Bitcoin in a new city. Nashville. Bitcoin 2024 is coming to Nashville in Tennessee, a city that is known as a music and freedom city. Bitcoin 2024 in Nashville from July 25th to 27th.
What is up, everybody? Welcome back to the show, FedWatch, your source for no-nonsense Bitcoin and macro discussions. My name is Ansel Lindner. I am joined by my co-host, CK. How you doing, CK?
Doing good. Happy to be back again. We took a little bit of a break. Both Ansel and I were traveling, but we're back home and we are here to do another episode of FedWatch just in time. So
yeah, big week.
Yeah, Ansel. How was vacation?
Oh, it was good. I went to the Little League World Series. It was here in Florida. So my daughters were playing in the softball Little League World Series. They did very well. They played with everybody. They didn't do a good job of winning, but they did a good job of staying up with all the competition. And so it was a great experience for all involved.
I mean, it is some really steep competition once you're at the World Series level. So that's pretty amazing to hear about your daughters being great athletes. But a lot to talk about in macro. I'd be remiss if I didn't talk about Bitcoin Amsterdam. We are dropping new and exciting speakers every single day. Go check out the site, b.tc/conference/Amsterdam. October 12th through the 13th, ticket prices go up every single month. And you can still get a ticket to Bitcoin Amsterdam for relatively cheap. It is coming up in less than 80 days. So see me in Amsterdam. I'm going to be at Bitcoin Amsterdam. And, we're going to have all the same Bitcoin conference magic, the news desk, all the amazing stages, incredible production, even better networking. So the entire European Bitcoin ecosystem will be there, and a really strong showing as usual from the Dutch audience. So the ticket sales have been strong so far. We are looking to have the biggest Bitcoin event in Europe ever. So some work to do there still, but the event is quickly approaching. But with that being said, use promo code BMLive to save an additional 10%. And Ansel, let's jump into any housekeeping you might have, my man.
Yeah, just the topics for today. We're going to talk about Bitcoin like we said there. We took last week off, so there's a lot to catch up on. Big week for the FOMC and the Federal Reserve. U.S. GDP dropped this morning, so we're going to take a look at that. ECB also had a policy decision today. And lastly, we're going to round it out with a discussion on China's economic model and some wake-up calls going on over there for the Chinese elite. But if that sounds good to you guys, make sure to like, comment, and subscribe. We can see the comments live. So if you're watching live on YouTube or Rumble, you can comment and we will get to those questions if we have time. But it is going to be a jam-packed show. So that's all. Other than, hey, guys, check out my other podcast, Bitcoin and Markets. You can find that at bitcoinandmarkets.com. Check out the Telegram and the Twitter and all that. So, all right. CK, you went to the Lightning Summit, correct? And so what were the updates the takeaways from the Lightning Summit?
So I did not. So I went to the Lightning Summit 2 weeks ago, and I mean, honestly, there was a lot going on. The networking was absolutely fantastic. There was an announcement of the Mutiny wallet, as well as a lot of kind of technical walkthroughs. When I go to these summits, I don't actually attend a ton of the content and talks. I'm more there to meet the Bitcoiners, chat with old friends, potentially create some business opportunities. I'm giving tours of Bitcoin Magazine HQ. So, it's definitely an active time for me. A lot of fun, though. And the energy around Lightning is very interesting. I would say from the developer's perspective, Lightning has a lot of failures. They're more focused on what's wrong with Lightning than what's right with it. But on the flip side, I was using Lightning to buy drinks there, right? There's Lightning startups founding and paying for the summit. So I think that obviously Lightning is making a lot of strides. On the flip side, developers are developers. Developers, they're in the weeds of what's wrong, right? They're the ones who break Lightning the most. They're the ones who have the most issues with Lightning. They're the ones with the most skin in the game, probably sats lost to the Lightning Network, forced closes, high fee environments, etc. So it's definitely a contact sport out there in Lightning land. So I would say that was like the predominant sentiment from the summit.
Yeah, it's interesting. When I think of development, I think of like the high level development being 90% thinking through problems, and so they can see down the road what part of the code, what part of the incentives, that kind of thing are going to have issues. And so, yeah, they are the ones that are leading that charge of looking what's wrong. So if you were to tell me the opposite, that they didn't see anything wrong, that actually I would maybe be more concerned with that. So yeah,
Totally.
I have a few little notes here of stuff. Tell me about splicing. Do you know what's going on? New news about splicing, and was it Zeus Wallet or who was that?
Phoenix Wallet. Yeah.
Phoenix.
So when you want to add liquidity to a channel, typically from my understanding, there's no way to like do a Bitcoin transaction to add additional liquidity. You have to like route it through the Lightning Network. So like when you open a channel, you have kind of like the initial amount and that's going out, and you have someone who's opening a channel with you with liquidity going the other way. And there wasn't a way to take outside Bitcoin who's outside from the Lightning Network and use it to top up a balance in your channel. And with splicing, effectively, that's a way to add additional liquidity to a channel that is already existing from an on-chain transaction. In terms of how that works, I don't know. I know that it was implemented in Eclair as a Lightning instance, or why am I blanking on the term? Node. Implementation. There you go. As a Lightning implementation, I know that C Lightning has had a lot of work done on it on splicing. So I think the only wallet in production, as far as I know, is the Phoenix wallet, which is built on Eclair. It's kind of vertical. It's like Eclair is made for the Phoenix wallet. And the Phoenix wallet is made to use Eclair, and they have splicing now. But I would say it's a relatively advanced feature, but it is a really big deal. It increases efficiency of the Lightning Network massively because you don't necessarily have to close a channel to open a new, better channel. That's huge. You can just re-up your existing channel, and also it's a utility, so it's a big deal. But it's very beta, very kind of advanced user software. What else? Hit me with your questions. I just like the economy, where I'm not that smart. I'm also not that smart when it comes to the deep technical stuff, but I'm doing my best here, guys.
All right. Well, I like that incremental improvements in Lightning. I have also been somewhat negative on Lightning in the last year because of the speed of capacity growth, and also that, what are your thoughts on this? That the UTXO set is just a limiting factor for Lightning. So you can't have all 8 billion people using 100 channels, right? Because the UTXO set would just be too big. So what are your thoughts on Lightning? Does that kind of sound similar to what people were saying at the summit?
Yeah, people were talking about how far can Lightning go for sure, and like what are Lightning's limitations. Personally, in my mind, I don't see Lightning as being like a consumer solution. I think that there are consumer solutions still coming. I think that like we are, we're still operating on the tank rails of Bitcoin. So for me, Lightning makes an enormous amount of sense as a B2B, like high value, high velocity of money, institution to institution model. When people say when people used to like call Lightning like is going to be centralized, like it's going to be a hub and spoke model. Like to me, that's dumb because it's only going to be hubs. like there's not going to be spokes. It's just going to be massive users. And that honestly, I think that's like where Lightning operates best, right? It's almost like, enterprise server level tech that is built on top of Bitcoin. And I like to just remind people how early we are. We're in year 14 of Bitcoin. We're about to experience having number 4 on Bitcoin. Like we're less than 1% adoption. When we are at these levels in the internet, we are in a very rudimentary stage, and that's still kind of where we're at in Bitcoin. So there's going to be much, much better tech than what exists right now. Much better tech.
All right. Well, going from that kind of consumer solution and Lightning on one side, there was some big news that went on the week that we were off, and that is RFK talking about backing the dollar with Bitcoin. And we have been on the forefront of this conversation, talking a lot about the inevitable, like people say the dollar's going to die, but I've always said the dollar's not going to die. It's just simply going to be backed by Bitcoin. So what were your thoughts on the RFK news and maybe the plans for how he's talking about implementing this?
It is, well, I would say the biggest thing to notice here is one, the fact that the Overton window is shifting around Bitcoin in the political conversation. Now you have, let's call it outside candidates trying to appease to the Bitcoin maximalist specifically the Bitcoin maximalist group. I think that that's extremely fascinating that that's happening. And that shows that our narratives are working. And that shows that our movement is building momentum, which is extremely bullish. And again, it's still early. Let's talk about the next presidential election after this one, right? Like, where's Bitcoin going to be then? The funny thing is we talk about CBDCs all the time here, and they're like, we'll ship this in 2030. It's like, where's Bitcoin going to be in 2030? Like when you finally ship. So, I really I'm hyper bullish on Bitcoin for these reasons. With that being said, what he said is interesting too. I think the capital gains element is much more realistic and a much bigger deal for Bitcoiners right now. That's going to make the United States one of the most appealing places to own Bitcoin, period. That's really what's important. On the flip side, the dollar being backed by Bitcoin, it's almost like a ridiculous promise right now, but I think it's something that becomes much less ridiculous, many years from now, maybe in 8 years. It just really depends on how fast Bitcoin escalates. But the dollar is going to have to be in a much different position before that's realistic. I think he did clarify those statements yesterday on the Spaces with Scott Melker and a bunch of other Bitcoin people. I'm not the biggest fan of Scott, but he had great guests on there, and it was a high value Spaces. So, you can't talk bad about that. But he did say, I wouldn't back all treasuries with Bitcoin. He really walked it back and made a much more eloquent kind of description. He's like, I would make sure that the treasury offers a U.S. treasury option or product that is backed by hard currency, including Bitcoin, which is, I think that's much more doable in the short term. Again, I'm not an expert there. Maybe you can be an expert to how doable politically some of these things are. But I definitely think two big things, huge takeaways is one, shift in the Overton window. That is the most important thing. And then in terms of the promises, the no capital gains promise, that is the most intriguing one for sure.
Yeah, absolutely. My initial response was, holy cow, he just busted open this Overton window for everyone to talk about a Bitcoin-backed dollar. And also the way that he's going to go, that he plans to implement it is, less than 1% up front, like you say, offer a product that is backed by Bitcoin. And that just gives the government a market reason to start buying Bitcoin. You don't want there's got to be something that pushes the US government out there into the market to start buying Bitcoin. And if you're going to back a product like that, then that just gives you that reason to do that. So slowly but surely, that product will have a lot of demand. It'll force the government to buy Bitcoin. And then the discussion gets even more clear. Okay. The US government, maybe in 5 years' time, they have 100,000 Bitcoins for this product. Now it becomes a much different conversation of fully backing the dollar with Bitcoin. But yeah, I was blown away by this plan. And it's coming from a major, candidate out there. I don't think that he will be successful. Maybe he will be, but it's just, yeah. If you would have asked me 4 years ago if somebody like this would be saying backing the dollar with Bitcoin, no way in hell. They were supposed to be fighting us, remember? And now they are actually adopting. So that's my comments on that.
The incentives work or they don't. No one's bullish enough. That's been my message for a long time, y'all.
All right. Well, let's jump into the FOMC. We have a few clips here, and I tried to break out the most important answers during the Q&A. But for just to summarize here, the Fed has raised by another 25 basis points up to 5.25 to 5.5%. That's their that's their Fed funds target range now. And that last month they had paused. There was some back and forth between whether that was going to be the last hike already or if they're going to hike again. The market was predicting a 99% chance that they would hike. So the Fed did not disappoint the market, and they went ahead and hiked the 25 basis points. We see CPI coming down. I think that will continue. So some of the reasons behind their hikes is starting to, get cleared up. And I have on the notes here about talking about oil, and I forgot to get a chart of that. But anyway, let's roll into the first clips. This is going to be risks on both sides. Sorry.
Hi, Chris Rugaber at Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now after trailing them for a long time. How much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that the public has that inflation is coming down, which will in turn, we hope, help inflation continue to move down. So you are really, sorry, but what your question was?
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it is for people. So how much of that are we still seeing with inflation now down at 3%?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the two risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not. But as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But we need to see that inflation is durably down that far. As you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think core is signaling where headline is going to go in the future. And core inflation is still pretty elevated. There's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3 or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So, but how much unemployment do you think is justified to get down that last?
So
it
is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, and that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And, you know, we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater, and that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity, and you know that's the thing we really need to avoid and will avoid.
All right. So on there, he was talking about risks. From that little clip, I took out that there's risks on both sides, doing too much and doing too little. They don't know what the balance is right now. They're kind of just moving very slowly and methodically. CK, I'd like to get your thoughts on that. Also, just overall from this first clip, we have been somewhat supportive of Powell because he seems to be a straight shooter. He's actually, I mean, I personally remember Yellen and Bernanke as Fed chairman, and Powell is just so much more of a straight shooter, somebody that I think can build confidence in the Fed. But what was your takeaway from this little short clip and Powell's performance?
Well, I think that the actual result, it was interesting because it confirmed the kind of narrative of the last FOMC meeting where they paused. It was like the hawkish pause, right? Where there was a pause, but they're going to raise more later. So they raised more. And I think in terms of, you know, him talking about these delicacies, or how delicate this, you know, the balance that they're trying to play. Like, I fully agree that that's the case. I would say everything that they're doing, the economy is reacting despite them. So like, they think that they brought inflation down. I don't think that any of their action actually brought number down. I think that that was just the economy by itself, and anything like they're just throwing false signals at the economy. Yep. Whatever is happening has really very little to do with them. And if anything, it would be better without them. But beyond that, you know, again, in the comments, someone comment Bitcoin fixes this. You know, I really do see, when I think of prices, I think of those as like economic measurements. And I think like right now we just live in this world where though, like on the base level, that is something that is kind of unreliable. So our economy will improve when we get to something that is reliable. I think that is Bitcoin. But despite believing that, the average person still believes Powell's narrative. You know, I know a lot of well-meaning, smart, educated people who have high-paying, white-collar jobs. They listen to him say that. He's like, wow, sounds like a reasonable guy. That's how the economy works. You know, that's still where we're at. And then, you know, the people who are a layer removed from them are like, wow, inflation's through the roof. And then the people who are removed from that are like Ansel, who are, you know, now they're really thinking into how the global economy works. So, you know, it's really difficult to navigate what's happening. And what he says on stage, I think he is very competent at, you know, holding the line in terms of managing confidence. And he looks good right now compared to how he looked like 6 or 7 months ago. That's for sure. So it seems like the heat has cooled down, and who knows if the results are good, but everyone is in this malaise that it's better. It seems like it's almost like in the short term, you know, he's at least pulled it off for now. So I'm curious what you think.
Yeah, well, I don't want the audience to get the wrong understanding that I don't think we need a Federal Reserve. I think that it would be best if we didn't have a Federal Reserve. And for a long time, I thought these Fed chairmen were evil, but maybe that's because we had not so good Fed chairmen like Bernanke and Yellen. They are just unlikable. Where Powell, I think, is more of, I don't know, kind of like a grandfather figure, somebody that is a little bit more likable. So, and also we brought this up on our last show about the multipolar world that I'm seeing is Wall Street and the Fed versus the BRICS versus Davos. It's not going to be the US, Russia, and China. These are different groups. And so the Fed and Wall Street is kind of like the enemy of my enemy is my friend at this point. Their RFK we just talked about is wanting to back the dollar partially with Bitcoin. So it just seems like, it's counterproductive to hate on everybody, right? And so I think that if we just take a common sense look at what Powell is saying, how he's saying it, what the teams are, that I think it's positive. This is a positive development. But anyway, what was I going to say about this? I said, okay, yeah, you were mentioning that the economy would have done this regardless of what the Fed did. And yes, that's one of the common narratives of this show. They talk about jobs numbers here in a second in the next couple clips. And what I'm saying, what I'm seeing out there is that as this headline inflation comes down, as quote unquote inflation, as CPI comes down, people aren't having to get as many second jobs. Maybe, the people that would have gotten a third job are not going to get a third job. So just by the CPI coming down, it relieves some of that pressure on the job market. And that's what we're seeing out there. We're not seeing any reaction from or reaction to Fed policy. We're just seeing reaction to this typical cycle. We had a supply shock, massive supply shock, war in Europe, and now we're coming down on the other side of this. And really, I don't see where the Fed has done anything mechanical to the market. So that's what I have for this first clip. Anything else before we go on to the next one, CK?
Now let's go to the next clip, and then I'll continue my ramblings after that.
Nick Timmeros of the Wall Street Journal. Chair Powell, markets widely believe the median FOMC participants' inflation forecast from June for the fourth quarter of this year will be too high, given autos and shelter, and that by September that may warrant a downward revision in the inflation forecast of 20 to 30 basis points. Would that type of inflation progress be enough to hold rates steady from here, or do you need to see below-trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, how much of this and how much of that. We'll be looking at everything. And, we'll be looking to see whether the signal from June CPI is replicated or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. Would another CPI report like the one we just had in June allow you to at least maintain that slower pace and defer until the fall any decision on whether you need that second rate hike?
So I'm just going to tell you again what we're going to do in September. We're going to look at 2 additional job reports, 2 additional CPI reports, lots of activity data, and that's what we're going to look at, and we're going to make that decision then. And that decision could mean another hike in September, or it could mean that we decide to maintain at that level. And again, the question we're going to be asking ourselves is the overall signal one that we need to do more, that we need to tighten further? And if we get that signal whenever we get it, then, and that's the collective judgment of the committee, then we will move ahead. If we don't, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
All right. What struck me about this one is he's talking about all the different types of data they're waiting for. He can't look at any one thing and see progress in, say, CPI, and that's going to totally dictate what they're going to do. But what struck me is that they have all all these different data points, but one tool. All they can do is raise or lower rates. CK, what's your thoughts?
Yeah, I mean, and what data is enough? How can you react to the data soon enough? Is quantitative tightening or easing quantitative if it's reactive, right? If it takes 6 months for this data to really get fully confirmed and updated and, they have these revisions all the time, so what data is the right data, and in what way is the right way to steer the economy? How can you steer an economy, which, if you think of it like a massive ship, if you're reacting in hindsight, right, like after it happened. So it's almost like a paradox. And yeah, I mean, that's why we think that it would be better on, let's just say, a even playing ground system where there is not the interventions from an outside arbiter. There is no correct data, and there is no human way for them to process the data in time. It might even be better if they were making gut decisions based on what they're seeing on the ground over what they're doing, which is like this data driven hindsight way. I don't know. What do you think about that, Ansel?
Yeah, well, that's kind of what they're doing. They're looking at the data and they're making their best guess, right? And so it is kind of just a gut reaction or a gut. They're going on their gut here a lot, but also
So I'm just saying, go with their gut, but forget the data. Just see what's happening on the ground.
Yeah, or
React to the narrative.
Exactly. Well, that's kind of what they do. They follow the market. Being data dependent, they could just get rid of the data and just pretty much follow the stock market or follow the bond market, and it would be pretty much the same thing. But let's keep rolling on these clips. The next one here is going to be about the Powell thinking there's going to be no recession. So let's roll it.
A good part of Wall Street has become more confident that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for recession. And I'm wondering if the staff has changed its view on the likelihood of a recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So it has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view, and I think that's sort of consistent with what I see today. So, but it's a long way from assured, and we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast. But given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we, as FOMC participants, produce. Having an independent staff forecast, as well as the individual participant forecast, is really a strength of our process. There's just a lot of, I think, constructive diversity of opinion that helps us informs our deliberations, helps us make, I hope, better decisions.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. I would say, though, that there's a pathway, and yes, that's a good way to think about it. We've seen so far the beginnings of disinflation without any real costs in the labor market, and that's a really good thing. I would just also say the historical record suggests that there's very likely to be some softening in labor market conditions. And consistent with having a soft landing, you would have some softening in labor market conditions, and that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment. We've seen softening through job openings coming down part of the way back to more normal levels, the quits rate, so people are not quitting as much. We've seen participation, people coming in, and so labor supply has improved, which has lowered the temperature in the labor market, which was quite overheated, going back a year or so. So we're seeing that kind of cooling, and that's very healthy, and we hope it continues.
All right, so they're seeing no recession. We have been talking about this on the show here. My odds were 25% no recession, 50% mild, and 25% hard recession or deep recession. And we also went through people like Jamie Dimon last year, and he was like, oh, we're seeing an economic hurricane. We're seeing big time, like a 30% chance of another great financial crisis. So all of these numbers are switching. These odds are switching, but this show has been pretty consistent. CK, what are your thoughts on the recession call?
Yeah, I mean, I think you're right. You've been saying, well, I think you said like 25% chance of hard landing, 50% chance of soft landing, 25% chance of no recession at all. And I think you've been saying that for longer than anyone else, much longer than Powell. But in terms of specifically, what this show has been saying and how people should think about it, for me, it's like, hey, maybe there's not a statistical recession, but I think life is getting harder and the economy is working worse for the majority of people. And like the actual infrastructure that we're living on is breaking down. So whether that is government services, whether that's roads, whether that is air travel, like it's definitely gotten much worse. I think I've taken like 45 flights this year so far. Air travel has gotten worse. I can tell you from experience. I'm no stranger to flights. So, there's this like paradox, like what's the stock market doing? What's the economy doing? Are people working? Are these measurements going up? And then what's life like? And I just think that life is just getting worse. And that's going to help people see Bitcoin, not to be the guy who always brings it back to Bitcoin.
Yeah, I totally agree. With CPI so high, you can have CPI crashing and GDP crashing at the same time. So that it feels like a big recession, even though statistically or by the numbers, it's not going to be a recession. So that was actually what drove my predictions on this. But yeah, let's keep speeding through these. Can we go to the next clip? Are you ready for that?
Last clip.
Thank you, Chair Powell. First, let me compliment your tie, the choice of tie. So thanks for taking our question. So the Beige Book, it said, input cost pressures remain elevated for services firms, but eased notably for manufacturing sector. Is that an indication that there's a wage inflation pressure? And how do you target and pressure on the wage inflation without pushing the economy into recession?
I think as it relates to goods, it's really an indication that supply chains and shortages are easing. And so what was the first part of it?
So wage inflation, like how do you target wage inflation without pushing an economy into a recession?
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there. And by so many indicators, labor market demand is cooling. You can look at surveys by workers and businesses who see that. You can look at the quits rate normalizing. You can look at job openings coming down. You can look at just job creation in the establishment survey has, it's still at a high level, but it was at really an extraordinarily high level for most of the last 2 years. So you see cooling, particularly in private sector in the last in the last report. So I think we see that, and it's happening at a gradual pace. So that's actually not a bad thing in a sense, because if what we see is a labor market, very strong demand for labor, which is really the engine of the economy. People are getting hired, many people going back to work, getting wages, spending money, and that's really what's driving the economy. But that it's gradually slowing, it's gradually cooling. That's a good prescription for getting where we want to get.
But still, we see a push to raise minimum wage. We're seeing a lot of unions go on strike or threaten strike. And the common thing is they come out with agreements like big pay increases, like UPS, and we have the auto workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
Not for us to comment on contract negotiations. Not our job, not our role. We monitor these things and we'll keep an eye on them. But really, that's something that's handled at that level, and not.
All right. So this clip was about the labor market. He did mention at the very beginning of his answer about goods and that supply chains have been pretty much sorted out. So the goods, quote unquote, inflation or price rises have been worked out, and now they're starting to see they're making progress. He took responsibility for this, that they're making progress and that they see it at a gradual pace. So CK, any comments on this?
No. They're getting into semantics, and the reality is that it's all getting sorted out based on the market, and really very little that the Fed's doing. We don't have very much time, and you got a lot of slides. We stuck on FOMC, so let's jump into GDP in China.
Okay, right before we do that, though, I just want to mention that what if the Fed has raised rates the fastest in however many years, 40 years, why would it be a gradual pace? You would think that if the Fed was actually doing something, it would happen much faster. But if the market was just working things out on its own, it would happen at a gradual pace, and that's what we're seeing. Okay, now, yes, let's go into
Good job, Ansel. I should have passed it back to you.
Let's go on to U.S. GDP numbers. So this will be starting with slide number 6, please, Chris. And what we have is that this came out this morning. Q2 GDP for 2023 grew at 2.4% annualized, and it was only expected to be at 2%. Of course, this is the first estimate, and we will have 2 more estimates or revisions that come out. So that could move down towards 2%. But right now it came in very, very hot at 2.4% annualized. And I wanted to read through this article here real quick. Let me pop it up. So this is from Business Insider. The U.S. economy is surging. Real gross domestic product, or real GDP, grew at an annualized rate of 2.4%. The advanced estimate for the second quarter beat 1.8% increase expected. So not 2%, but 1.8%. The estimate is above. Okay, let's move on to the meat of the article. According to the Bureau of Economic Analysis, real gross domestic product went up by 2.4% in the second quarter. That beats, this is a regurgitation of this over and over again. Next slide, if we can go to the next slide. This is the chart of quarter by quarter annualized real GDP. So you can see it was negative there at the beginning of 2022, 2 consecutive quarters. That was not called an official recession because the National Bureau of Economic Research said, no, this didn't meet all the criteria. It only met this 2 consecutive quarters, but there was no jobs part. There was no a few other things that would make it an actual recession. Anyways, since then we've seen positive real GDP, and this one actually accelerated a little bit from Q1. And if you go to the next slide, what I did was I went back in time and looked at the Great Financial Crisis to see if, reacceleration of GDP, does that mean we're out of the woods? And I'm comparing it here to Q2 of 2007, where it hit a new high, just a little bit higher than Q4 of 2006. And then within the next year, we were in recession. So this doesn't mean we're out of the woods, but it could mean that we're out of the woods for the next 12 months. Maybe we have to wait till Q3 of 2024, right before the presidential election, basically, till we can see some recessionary numbers. And that would be very interesting political timing as well. But CK, any thoughts on the GDP here? We're done with that.
I think that this is a great framing, is to kind of frame it to the last cycle and how things played out, because it's funny. People like to zoom out and look at annual numbers, and then they like to like zoom in and like look at how things are going quarter over quarter. And the reality is if this is a cycle, if this is cyclical, it's gonna rhyme to what it looked like in the past. So, we'll see how it actually plays out. But at the same time, it is interesting if you reverberate back. We have had some positive GDP, but it's nothing like 2021. I know things were very heated up there. But at the same time, definitely, it seems like the economy hasn't been the same since. And, a lot of that I'm sure is, the wealth effect is, people don't feel rich. Stocks are down, crypto's down, all this like stuff is down. And it's, it seems like people are paying their debts a little bit right now, and things are getting a little bit harder. So, yeah, I mean, that's been kind of like my undertone for a while. Do we want to say anything else about GDP?
Just that I still expect low growth, low inflation is the new normal after the great financial crisis, with periods of a deflationary shock or shocks. And that's kind of what we've seen. The CPI, or quote unquote inflation, was transitory, and we are just returning to very minimal growth. 2%, in my opinion, is minimal growth, and we'll probably see between 1% and 2% going forward in the future. So anyway, yeah, that's all the thing I have to add on that. Are you ready for China?
Let's do it.
Okay, China is in big trouble, and experts are starting to come out and say that China must rapidly change their whole economic model. This is a translation from Zhang Zheng. Sorry for the pronunciation, but Zhang is a distinguished professor of humanities and social sciences, dean of the School of Economics, and director of research at the Fudan University there in Shanghai. So he is one of the premier experts, and he's saying that China has to change their economic model. They cannot be reliant on the export-led model. They need to switch over to consumer-led model. And I thought Michael Pettis had a good tweet thread on this. If you could pull up the next slide, that is from Michael Pettis. And I will just read through here. Thanks to Pekingology for translating the speech. And of course, I will link this in the show notes when this comes out on podcast version. Zhang recognizes very clearly that a once successful development strategy is now obsolete. But the need to raise wages, he says, quote, is a significant blind spot in the discussions within the Chinese academic community, as all the discussions revolve around the development of enterprises and industries with very little attention given to wage issues. China is not yet developed an effective policy framework for determining fair wages. So this is like, of course, communism. You don't have this robust free market to determine fair wages. They have to actually set this by the Politburo or by the Central Committee. So this is what he's saying, that they need to develop a policy framework to determine wages. It's a communist specific problem. And he continues here. And the mechanism for collectively bargaining is virtually non-existent. China needs a reasonable wage formation mechanism that can better synchronize with GDP growth. He argues that it is crucial that Beijing switch as soon as possible to a supply-side model focused on investments to a demand-side model focused on rising wages, quote, to address the transition from the catch-up model to a post-catch-up era. So catch-up model would be like, or catch-up eras, China was very low income 50 years ago. They have since caught up pretty much, becoming the second largest economy in the world. So they're now in a post-catch-up era is what they're saying. And they want to switch from manufacturing, being the biggest exporter in the world, to being probably the largest consumer in the world, which is where the U.S. is sitting at this time. Continuing on here, the switch should have happened at least a decade ago, according to Zhang. And because it didn't, China has wasted resources on investment with no real return for the economy. Overproduction, overinvestment in all of these unproductive ghost cities, and not unprofitable rail, high-speed rail lines, Belt and Road Initiative, all of this stuff I've been saying for a long time has been overproduction and zero productive value. And this is exactly what this Zhang is saying here. But while it is good that more and more of China's leading economic policy advisors recognize how urgent it is that China rebalance away from investment to consumption and what that requires, I think they still do not recognize why it will be so difficult. In the same speech, for example, Zhang talks about the impregnable strength of the Chinese manufacturing versus that of the US and other countries, but he fails to recognize the extent to which this strength is the result of precisely of China's extremely unbalanced growth. So the reason why they can be so dominant in manufacturing is because of the model. They can't just become dominant in consumption as well. They're going to have to lose dominance in manufacturing, and they're not prepared for that. Continuing, China's manufacturing competitiveness is not quote unquote natural and certainly not inevitable, but instead is based on the enormous direct and indirect subsidies that are the obverse of the low wage share that he correctly wants to reverse. That is why rebalancing has always been so difficult for other countries and is likely to be even more difficult for China. It means improving the quality of growth in the medium and long term, but at the expense of the overly cosseted manufacturing sector in the short term. He is right, in other words, to say that at this stage, China's economy requires that wages catch up to GDP, but what he doesn't recognize is the extent to which China's manufacturing and export strength are based on the fact that wages have lagged for so long. And that is the end of the tweet thread by Michael Pettis. Very, very good. I recommend following Michael Pettis if you guys are not. He is an expert in China. But to sum up, their economic model needs to change. They can no longer be dependent on manufacturing. They've pretty much tapped that out. They need to switch, but they're running into the low income trap, right? Where they can't make that next step from a low income economy to a middle or high income economy. So CK, what are your thoughts?
I mean, I think one of the things I would say the very earliest thesis of this show was bullish US/North America, bearish Europe, bearish China. That was the original thesis. I think that thesis is transformed into bullish, let's just call it Wall Street, dollar, and Bitcoin, bearish WEF, globalist, bearish China/BRICS in terms of global dominance. So we've been pretty damn consistent. That was like over 2 years ago when Ansel really presented that thesis. And we've been very, very consistent about that. So I guess Ansel, I think you've been very directionally correct here. You've been calling out, almost like this like slow motion fall of China, the realizations that, their top-down model has been broken and ineffective. How do you feel right now? Kind of, again, I think we're seeing China, if China has to topple all the way down, China's like right here. It's like at the top, it's at 1 o'clock, in terms of, if 12 o'clock is straight up. So there's a long way for China to fall from here, I think. But what do you think?
Yeah. Well, it all comes down to China's model being based on the existing economic order, with all of the international institutions like the WTO, the World Court, all of the existing Forex institutions and trading and things like that. And so China is dependent on the way things were pre-COVID. And now moving post-COVID with deglobalization, that is going to harm their economy. I don't think they're going to collapse or anything, but a very good example would be just look at what happened in Japan in 1990. They were supposedly going to overtake the US within a matter of years. This was all over academic circles. It was all over like the financial press that Japan was the new behemoth on the block, going to overtake the US. We heard that exact same thing the last 5-10 years about China. And look what happened to Japan. they've been pretty much stagnant for the last 30 years. And I think that's probably going to happen to China as well. So they don't have to topple completely. They're just going to stop growing. They're going to come down to earth like everybody else. And, you know, the CCP is dependent on 7% growth. They're dependent on making a difference for their people. And if they can't do that, does the CCP continue to keep control of China? So, yeah, there could be a political shakeup, but I don't think the Chinese economy is going to collapse tomorrow. Does that make sense, CK?
No, it makes sense. Like I said, most of these things happen in slow motion. And because of Bitcoin, the people have a choice where they can opt out and they can continue to build, let's call it the local economy. So, not to say they have to go full sovereign individual and leave, even though a lot of miners and businesses have left
Yeah.
China because of their unfriendly stance towards Bitcoin. But still, ultimately, that's the whole point about Bitcoin is it gives you opportunity to opt out of a bad system without having to leave. And I think that that's super
Absolutely.
bullish. I know that we have to wrap pretty soon. You know, I want to hit you with one tough question here, Ansel, before we do,
All
which
right.
is if you were to make an estimate when it takes or what would it take for the CCP to lose power over China? What would be like your estimate there in terms of years?
In terms of years, well, I think that they would have to lose a military conflict. Like, let's say they try to invade Taiwan and it doesn't go as planned. I think that could lead to a very rapid change of power, the CCP losing power. Also, if they just have an absolute recession, like not just GDP around 3%, but if they actually had some negative GDP for a year or so, I think that would have some major consequences politically for them. So those would be what I'm watching for. And time frame, who knows? 5-10 years, there's a rising chance that the CCP won't be around.
All right. I think that that's fair. Honestly, I think the world is a very different place in 2030. 2030 on is a completely new paradigm. That's been kind of my view for as long as this show's been around. So that's what I bring to the show is that time frame. But Ansel, another great one. Y'all, this is Fed Watch. This is the only show that talks macro and Bitcoin and takes these deep dives into what these central bankers are saying, what is happening across the globe. Ansel does a great job of curating that information. I'm CK. I'm going to be at Bitcoin Amsterdam, October 12th to the 13th. We'll see you there. And Ansel, any housekeeping to close it out for yourself?
Nope. Check out bitcoinandmarkets.com. Thanks to the community hanging out on Telegram, and I'll see you guys next time.
See you guys next Thursday. We'll be right back here. Peace.